So damages may be classified as performance damages or non-performance damages. And in our last lecture, we talked about performance damages. Things like making a party sell the good or making a party pay for the particular good. Today, we're going to focus on non-performance damages. And non-performance damages are what we call monetary damages, money damages. Historically, under the common law, there were actually two different legal systems. One that oversaw performance damages and another legal system that oversaw monetary damages, non-performance damages. Well, we've combined those two, thank God, but yet we still make a distinction between the type of damage. Monetary damage, again, you can think about as money damages. Now, there are three components of monetary damages, three different types of damages that together make up monetary damage award. Meaning, when it comes to calculating damages, you must look at three components. You must add three components together in order to arrive at the final figure. The first of these is called compensatory damages. And compensatory damages, we're going to talk a lot about them in more detail. But in essence, compensatory damages means what would it take to compensate the aggrieved party for the loss suffered under the contract. Incidental damages are damages that flow from the breach that were not the actual benefit of the bargain, but were caused by the breach. And finally, consequential damages, damages that resulted from the breach that were not directly caused by the breach. They are indirect damages. Let me explain each of those in more detail. Compensatory damages compensate the non-breaching party for the injuries that were actually sustained. The loss of the benefit of the bargain. The reason that you got into the contract, you were deprived of. So compensatory damages say that if a seller fails to deliver conforming goods and the buyer goes out to purchase substitute goods, then the measure of damages is going to be, did the substitute goods cost more than the contract price? And by how much? That's going to be your compensation. Going back to that same idea of me selling the computer to you and then subsequently breaching that agreement, we said that I'm going to sell the computer to you for $500, but I breach. I failed to perform. You've got to go out on the market. You find one for $700. That's a substitute good. And the difference between the market price of $700 and the contract price of $500 is your compensation. In order to make you whole, you must be able to get $200 because you expected to pay $500 and have a computer. Instead, you paid $700. So to compensate you for that loss, I have to pay you $200. This is different than performance damages in which I would have to sell you the computer for $500. The end result is the same. You paid $500 and you got a computer. It's just a different way of getting to that same result. Now, incidental damages are damages that are the expenses incurred after a breach, following a breach. These are damages that were caused by the breach. Really, when you think of incidental damages, especially for the purposes of this class, you can look at it as the cost of mitigation. How much did it cost you to minimize your damages? So when we had that situation where I was going to sell you my computer and I failed to do so, and you bought one for $700, well, there was actually another cost involved in that purchase other than $700. You had to go out and spend time and energy to locate that substitute good. That's a cost. That's a cost you would not have incurred but for the breach. And it's the same on the seller side. If you failed to buy my computer for the $500, and I was forced to take the time and the energy and the money to run another ad and to sell the computer and to meet with someone else, there's a cost involved in that mitigation process. So say I go out and I have to go through all that and I wind up selling the computer for $350. Well, I'm out $150. That's my compensatory damages. But I'm also out the time and the energy and the money that it costs to find another buyer. So those costs, the cost of mitigating, are also recoverable, because to meet your expectation, to make you whole, we must calculate both the compensatory damages, the loss of the benefit of the bargain, and the incidental damages, the damages that we're going to add to that cost. So in that original example, I failed to perform under a contract to sell you my computer for $500. You go out and you find one for $700. Let's say that you can prove up that it cost you $50 to find that substitute good. Well, that means that in order to make you whole, I must not only pay you the $200 difference in contract price and market price, but on top of that, I must pay you for these damages that would not have occurred but for the breach. You would not have gone out and had to look for a substitute good had I not breached. So if it cost you $50, then that means in order to make you whole, I have to give you not only the $200 in compensation, but I must also give you another $50 to make up for your incidental damages. So now, in order to make you whole, I have to pay you $250. Now, attorney's fees are a special type of incidental damage. When we sue someone to recover a contract, theoretically, attorney's fees are incidental damages. They're expenses I would not have occurred but for the breach. But in the United States, we have a rule against awarding attorney's fees unless the parties actually decided that in advance. And so we have a situation that in the United States, we cannot ordinarily recover attorney's fees as incidental damage. The United States tends to take the view that litigation should be a frictionless event, that we should be able to sue and hire attorneys without having to, that effectively there's no cost to that. Or if there's a cost, it's also going to cost the other party, and therefore it all evens out. For your purposes, just know that recovery of attorney's fees is going to depend on which law applies. Even though technically they are clearly incidental damages, damages that would not have occurred but for the breach. And the final component of damages is called consequential damages. And consequential damages are those damages that arose as a consequence of the breach. If, for instance, in a sales transaction and I was going to sell you Halloween costumes and I failed to perform, well, you have lost the benefit of the Halloween costumes, right? Because you got to go out in the market and you buy substitute costumes. So there's going to be a difference between the contract price and the market price. And it's going to cost you time and effort to go find those substitute goods. But if I was supposed to deliver those costumes on September 15 and I did not, and it took you 2 weeks to obtain substitute goods, that's 2 weeks worth of business losses that would not have occurred but for the breach. They flowed from the breach. So in order to make you whole in that circumstance, I would not only have to pay you the difference between the contract price and the market price, whatever the cost of the substitute goods minus the contract price, and not only and pay you the incidental damages, the cost of mitigation, the cost to find substitute goods, but in order to make you whole, I really need to pay you the 2 weeks worth of profits that you missed out on. So those are consequential damages. They are not directly caused by the breach, but they flow from the breach. They are an indirect result of the breach. Now the key phrase here, of course, is reasonably foreseeable, because what happens with damages is that damages can increase dramatically. And so if we are going to include loss of profit as a consequential damage, and the purposes of this class, we're really going to be focusing on loss of profit as the consequential damage. Well, the cost of the loss of the profit, well, does it apply just to this particular transaction, or how far out do we go? If 6 months later your costume shop goes out of business and you want to sue for all the profits that that shop would have made if it not for the breach, well, we have to cut that off at some point. And so the way we cut that off is through this concept of foreseeability, that consequential damages must be foreseeable. And it must be foreseeable to both parties at the time of contracting. Now, this foreseeability requirement is there in both the common law and the UCC as well. Both of these say that consequential damages are recoverable. However, they must be foreseeable. Now, foreseeability is a complicated topic because there's two different ways of looking at it. Is it these particular parties did not foresee the possibility of loss of profit? Or is it, would a reasonable person not see the opportunity for loss of profit? Well, the CISG's test says it must meet both standards. These particular parties and what a reasonable person would believe. If it was foreseeable, then to a reasonable person, that's an objective standard. If it was foreseeable to this particular person, that's a subjective standard. Liability is based both on what a party foresaw, and liability is based on what a party ought to have foreseen. So not only what you foresaw, but what you should have foreseen. Subjective and objective standards. The test is not based on the reasonable person so much as it's based on the reasonable foreseeability of the breach. Would a person have reasonably foreseen this particular breach? This is a complicated topic. For your purposes and for the test purposes, just know that foreseeability is a requirement in order to obtain consequential damages. And that foreseeability requirement is both subjective and objective. Interest is another type of damage, and again, the CISG provides for if a party fails to pay the price, the other party is entitled to interest on it. If in fact you breached and you failed to pay me the $500 for my computer, I am going to be compensated by the amount of interest that $500, if I'd taken and put it in the bank immediately, would have earned between the time that I should have received the money and when I did eventually receive the money. So if you pay me in 3 years from now, I'm entitled not only to the original sum, but to a reasonable rate of interest on that sum. Another special type of damage are called liquidated damages, and these are a form of monetary damage, but they're a special form because these are monetary damages that the parties calculated at the time of contract formation and actually placed into the contract. So we often see liquidated damages in construction contracts. If a building is not built by a certain day, then the cost of damages accrues at, say, $150 a day, or $1,000 a day, or $10 a day. There's some figure that we include in the contract itself. So these are meant to free a court from having to make its own calculations, because it can rely instead on the liquidated damages, the amount of damages that the parties have already calculated. And so in the case of liquidated damages, the liquidated damages would would supersede any calculated damages based on the CASG. This is kind of another example of how the contract is what ultimately controls a business transaction. It's not the contracting system, because the contract can supersede the contracting system. And so even though we have these rules for the calculation of damages, if in fact the parties want to calculate that in advance and put it in their contract, they are free to do so. We said that one of the benefits of this idea of monetary damages is that they can be calculated. And I'm actually going to upload a separate presentation on how you calculate damages. But in general, the idea is full compensation. What would it take to make you whole? What would it take to meet your expectation interest? And here's Article 74, and again, the idea is that you are entitled not only to the loss of the benefit of the bargain, but to the mitigation cost, and in fact the loss of profit, those consequential damages that may have flown from the breach. Under Article 74, an aggrieved party is entitled to be compensated for the value of its unrealized contractual expectation. That means you're entitled to receive your expectation interest. And again, we call this non-performance loss, or direct loss, or loss in value. And it is typically measured by the value of the benefit which the aggrieved party has been deprived of, or the cost of reasonable measures to bring about the situation that would have existed had the contract been properly performed. I said that compensation is generally measured by the difference between contract price and market price. And again, the CISG makes it clear that the compensation is ultimately going to be about the difference in value between what the aggrieved party, the non-breaching party, should have received, and the value of what was actually received.